what is buying a put mean? When you buy a put at a particular strike price, you have the right but not the obligation to sell the stock at a specific price within the specific expiration. Of course, you have that right until the option expires. So let's do an example. Why would you need such a right? Okay, right now, say Apple is at 132, okay, and you own Apple shares and your cost basis is $20. So how do you protect your gains and not panic out of selling your Apple shares? This is where we call puts as being a protective put. What does a protective put means? You are trying to protect your gains because your cost basis of Apple shares is $20. Right now, Apple is trading at around $130. So 130 minus, if tomorrow the market crashes or tomorrow during an earnings call, Apple says something and the stock tanks by say $100, which is not going to happen, but either way. So we are looking at protection, okay? Apple earnings are coming up and you are worried about the downside in Apple. By buying $100 puts, you will have the right to sell the Apple stock at $100. If for any reason Apple trades at $80 or any other price below $100, you will have the right to sell it at $100. So you would lose the $30 profit that you are seeing right now because Apple is at $100, but you will have the right, if it is closing at $80 and you have the right to sell it at $100, you are gaining $20 over here, right? Because somebody else would have to sell it at $80, but you have the right to sell it at $100. Okay, so then let's look at it. Now Apple is trading at 130 and you have bought $100 put. Tomorrow if Apple trades at $125, what happens to your puts? Your right to sell Apple at $100 just became more valuable. Why? Because the chance of Apple getting to $100 has increased compared to what it was yesterday. Okay, at 130, when the stock is trading at 130, there is $30 price difference between the put that you have bought versus where the stock is currently trading. But if tomorrow, because of the market conditions, Apple trades at 125, which means in one day it dropped $5, so you have a greater chance for Apple to go to $100 because now it's only $25 away and you just lost one day, right? So the chance of Apple getting to $100 has increased compared to what it was yesterday. Hence, when you buy a put, your puts become more valuable if the stock price goes down. Hence, when one is bearish a stock or expects it to go down, we buy puts to profit from that move lower. Okay, so we know when the stock goes up, you buy calls. When the stock goes down, you buy puts. Okay, now this is in options. What about in stock? Okay, in stock there is only one thing that we have basically learned: buy low, sell high. So if the stock price is here and it goes there, you bought it here, you sell here, you make money, right? This is where you make money. But what if the stock price is here and it starts going down? How do you profit from this down market with only stocks? This is not usually taught. This is called short selling. So you sell over here and then wait for it to go down and then you buy over here. That is called you're selling stock short, or that is called short selling. And we know what has happened with GameStop right now. So this is what the hedge funds have been doing. Okay, but what has happened to the stock? The stock has kept going higher, and so there is no amount of risk. That it has an exponential amount of risk because the stock can go to infinity. You are seeing a $5 stock became $40 and now it's almost at $500. So this is a very risky strategy. But when you buy puts, the only thing that you can lose is the premium that you have paid, and you're still participating in this down move by buying a put. So buying a put is a safer way to profit from a down market than selling short shares. Okay, and then let's erase this. So buying puts is similar to selling the stock short without the unlimited risk that selling a short stock carries with it. The maximum that you can lose is going to be the amount of debit you have paid. Hence, when you buy a put, your puts become more valuable if the stock price goes down. So when you are bearish a stock or expect it to go down, we can buy puts to profit from that move lower. So this is how the risk profile looks at it. Okay, so if you are buying SPX puts, okay, for February 19, 3000, you think SPX goes right now, it's around 3690 or so, and you think in 15 days or 19 days, February 5th, okay, this is talking about February 5th. If you think it goes to 3500 or close to that, 3550 put is at $21 right now. Okay, so whatever you're paid, but as it goes down, look here, this is your graph, the profit potential. Okay, what you've paid is what you can lose. If the stock market keeps going up, you lose your $21 that you have done. So you are capped at the loss. The $21 that you've paid, that is the only thing that you can lose. Whereas as the stock market goes down, or as SPX goes down, okay, this is 37, 3600, 3500, you are exponentially making money, okay, by buying put. Because over here, if it comes to 3200 or 3300, you are so much in the money because you bought 35. This is where it shows. Okay, this is where the put that you have. Okay, what would happen if the stock goes up? The debit or the premium paid will lose its value, since the chance of Apple shares going below $100 has reduced. Okay, so you are not, if it goes up, you lose the debit that you've made. If it goes down, since the probability of it reaching to your strike price has increased, your put value will increase. Okay, but what happens at expiration? Let's look at what happens at expiration. Later I'll explain you. Now, what is selling a put? When you sell a put at a specific strike price, you have the obligation to buy the stock at that price. Okay, of course this obligation only holds true till the option expires. So let's take the example of Apple stock that we have been talking. Okay, if I sell a $115 put for February 19th expiration, it means I have the obligation to buy Apple stock at $115 price. To take on this obligation, I am getting paid around $1. And we always talk about one option contract controls 100 shares. So you'll multiply that $1 by 100 to get $100. But to assume that obligation, I am getting paid. I am getting that premium in my account. So $100 I am getting in my account. But I have to put up some margin. And that margin is around $2,100. Okay. If by February 19th, Apple closes below 115, then there is no value to my obligation, right? If I have to buy over there at, okay, so it is going to be worthless. Hence, I keep the entire $100 and my margin is released. Okay, I have the obligation to buy it over there. But you tell me when in the marketplace, okay, because if I sold, somebody else bought it from me, right? If somebody else bought the right to which I have the obligation, somebody bought $115 put which I sold, okay, in that they have the right to buy it at 115. But if the stock closes at 120, why would they want to sell their stock at 115 when they can sell it at 120? So they are not going to exercise their $115 put that they have bought. So there is no way I can get the stock assigned to me. Okay, I hope I'm making it clear. I'll repeat. Okay, when I am selling the 115 put, I am assuming the obligation to buy Apple stock, right? But somebody else is buying that right from me. I am having the obligation, which means somebody else has the right. They have the right because they bought the put. They have the right to sell it at 115. If at expiration Apple is at say $120, the person or whoever it is that bought the $115 put, why would they sell their Apple at 115 when they can sell it at 120? They're not going to do that, which means that my 115 price, that put that I sold, is out of the money, or it has no value, it is worthless, so I can keep the entire $100 and my margin is released. Okay, now let's see what happens if Apple falls below 115 price, then I am obligated to buy Apple stock at 115. The stock will be assigned to me, and 115 times 100, because always one contract controls 100 shares, 11,500 from my account will be used to assign me 100 shares. Because somebody else bought it at 115 put, they are going to exercise their right. They will exercise their right, hence I will be assigned the share. But I would be paying only 11,400 because I received the $100 as premium, right? To assume this obligation. Okay. So now you would say, why to make that $100? I am assuming such a big risk, right? So the main reason is if you want to own some shares at a lower price, and rather than me, right now the Apple price is at 130, which is the current price, I can sell puts, and Apple, if it gets to that price, I get to own it at a lower price. If the stock does not reach at that price by expiration, I get to keep the $100. Hence, this strategy can be used to create monthly income stream on stock that I do not mind owning. Okay, so I don't mind owning Apple stock. I can think about doing somewhere here. If I don't want to own a stock like GE, there's no point selling there because I am taking undue risk in my mind. Here I am fine owning it, so okay, it's going to be my long-term hold, and I don't want to buy Apple at 130, but at 100 I'm fine owning it, so let me sell 100. Okay, and then it would be what? It would be $100 cheaper for me. And if I keep doing this to create an income stream, say I keep doing this for a year, once a year there may be in earnings or someplace, every week I can sell $100 put on Apple, create $100 of income, and wherever the market crashes or Apple falls down and it gets assigned to me, I'm fine. By that time, suppose I would have 6 months are gone, and 6 months, and there are 4 weeks in 1 month, so 6 months times 4, 24, I made $2,400. And then if I get assigned at $100, 100 times, right, at $100, 100 times 100, I put $10,000, but that $10,000 now is going to be, my cost basis is now only $8,400. No, I got $2,400, so it's $7,600. So I owned Apple at $7,600, not at, even though I am selling $100 put, right? I'm selling $100 put, which means I am ready to buy it at $100, and if it goes at $100, I will be assigned. So 100 times 100, I will be putting 10,000. But it took 6 months for it to get there, and every week I have been selling $100 put for around $100. Okay, $100, and I counted 6 months means 24 weeks. 24 times 100, so I made $2,400 as income. If you are going to take that $2,400 from here out, I am left with $7,600. So I paid only $7,600 for 100 shares of Apple. So now my cost basis is not $100. My cost basis is $76. Okay, so there is an advantage to selling a put, even though initially it may seem like I am putting $2,100 margin and getting only $100 out of it. Selling a put is an income creating strategy, or you can consider it as cost basis reduction. Okay, this is an example. I don't mind owning Apple, and 100 is fine by me. Every week I keep selling it. Whenever it hits, it hits. But how many ever weeks I was able to generate that income, it was going against. You can use it as cost basis reduction. You can do this over and over again. Okay, now I kept saying that it is very risky. Okay, why am I saying that? Let's look at a scenario where it can be very risky and you can have huge losses. Okay, when you sell a put, the assumption is that you're willing to own the stock at that price, and hence assuming the obligation to buy the stock at the strike price at which the put is sold. Okay, so how do you there are scenarios when you can have huge losses, and how to manage that if you don't know, it can be painful. So let's look at a scenario. Okay, suppose I sold $25 puts in American Airlines in February 2020, okay, for February 28th expiration. At that time the price was $30. Then all of a sudden lockdowns were announced and the market fell, and the American Airlines stock closed on February 28th on expiration at $17. So now I was assigned the American Airlines stock, okay, because I had sold those $25 puts at $25 per share, right? So 25 times 100, I had to pay $2,500 for it, okay, even though the market price was $17. So at market I would have been able to buy it at $17, but I had to buy it at $25 because I had assumed the obligation. So the moment I got the stock assigned to me, I lost $700, right? $7 per share over here, and then $100 per 100 shares, so $700 I lost. And now the moment I get assigned, I am losing $700, and I have to keep waiting for American Airlines stock to go over $25 to break even. Now if something like that happens on a stock that you want to own, you are willing to wait for the break even, correct? Apple, fine, $100 put I want to buy, I'm fine, it's gone to $90, I'm fine owning Apple stock, it gives me a dividend, I don't mind holding it for long term, that is what I anyway wanted to do. So because of those mindset, because I wanted to own that, the $10 loss if Apple goes at 90 and you got assigned at 100, that $10 per share won't seem much because you are anyway wanting to own it. But trying to do this kind of scenario with stocks that you don't want to hold can give you huge losses if the market turns, and then you are trying to get out of a big loss on something that you never wanted to own in the first place. Okay, so that is something that I would not suggest anybody do it. Okay, so the risk profile of selling a put is like that. Okay, whatever you got premium, whatever premium was received, that is the max that you can receive, because you get whatever profit in the beginning, whatever money you're supposed to get, you get in the beginning when you open the transaction. And if it keeps going down, you keep losing that thing, and you are losing money. If it goes up, okay, the premium decays and you will have that much money in your pocket. So now let's think about the intrinsic and extrinsic value. Okay, current price of Apple, I just looked it up, it's $131.90. So if you buy a $135 put, the premium currently is $7.50. Okay, so times 100, so you're talking about $750 you're spending to buy one put. Okay, one pays, okay, so you're paying $7.50 or $750. Now you know there are two components for every premium that you're talking about, intrinsic and extrinsic. Okay, so now what's going on? Okay, so $135 put is your buy minus the current price. Okay, so that's $3.04 is the intrinsic value. So $304 is the intrinsic value. The rest, $346, is the extrinsic value. The extrinsic value is just the premium for the time that you are using, the time that you have for being ripe, okay, that you're paying, whereas this is the intrinsic value. So tomorrow if Apple does not move till expiration and it is at $131.96, okay, $304 is what you will have remaining. The rest, $346 of extrinsic value will decay off. Okay, but if you buy a $130 put, it is outside, it is out of the money. Why it is out of the money? Because currently, okay, I can sell, if the market value of Apple is $131.96, I can sell it at $131.96. Why would I sell it at $130, right? So that is out of the money and it has only extrinsic value, and currently you can buy those puts for $480. Okay, at expiration an option has only intrinsic value. All extrinsic value becomes zero. So if Apple closes at the current price of $131.96, the $135 put will be worth $304. The $130 put will become zero. What if Apple closes at $129? So even though Apple moved down in your direction that you wanted, you would lose money because $135 put would be worth only $6. $135 minus what is the current price? 129. Okay, so you will have $6 worth of premium left or intrinsic value left. This is we are talking about at expiration, but you paid $7.50, so you lost $1.50 because it did not move fast enough for you, or it did not your break even. So when you are paying $7.50, you are saying that it will close on expiration below that $7.50 from 131.96. Okay, so your break even is going to be break even point. If you pay $7.50 as your debit, so then you are expecting break even. This is at expiration. You want it to go $7.50 below. Okay, and so you're looking at 46 here, and this is going to be, you want your Apple to close below 124.46. That is when your $7.50 will make some money at expiration. Okay, but as long as the moment you buy and Apple will move, market is moving every second, so at the moment it goes in your direction, your option value will become either more valuable or less valuable. Okay, so that will keep happening. This we are talking about at expiration. So in conclusion, every second the market is moving, and your options are going to be whether you buy a put call, or you sell a call or a put. Your right or obligation is either becoming more valuable or less valuable based on the stock movement. Okay, and so we traders use these instruments, options of buying call or selling calls, buying puts or selling puts, to our advantage. Okay,